Do you want to get paid to buy your favorite stocks at a discount? This is hands down one of the best kept secrets in the stock market because unfortunately, a lot of people when they first start out, they have no idea that this strategy even exists. So in today's video, I'm going to show you how cash secured puts can help you buy the stocks that you want to buy anyways for a cheaper price, and we're going to get you paid while you're doing it. We're going to cover the pros, the cons, everything in between. And before the video ends, I'm going to show you a live example of a put that I sold today in my own account. By the end of this video, you're going to understand everything that you need to know about selling put options. And you're going to be a lot more confident about going out there and executing your own trades on your own. You will now be able to understand exactly how I've been able to generate consistent profits just like the ones right here on the screen. So you too can go out there and make consistent profits for yourself right in your portfolio. So go ahead and grab yourself something to take some notes with, either a pen and a pad, or go ahead and grab your phone and open up the notes app, something that you can jot down some of the key steps to do this properly. So first things first, we need to understand what a put option even is. There are two sides to a put option. There are the option buyers and there are the option sellers. When you sell a put option, you have to make sure that you're clicking sell, because if you decide to buy the put option on accident, you could lose that money that you're putting into that put option. It's a whole different side of the trade. If you're trying to sell puts, you do not want to end up on the buyer side. Don't do that. So before you even do anything, you have to know what a put option is. What is selling a put? What is a put option? A put option is basically a contract that gives the buyer the right to sell 100 shares of the stock at a specific price before a certain date. The specific price is basically the strike price, and the certain date is called the expiration date. The buyer of the put option wants protection. They're paying for the right to sell the stock at a set price. Usually they're doing this because they're a little worried that the stock's going to drop in price. And the seller, you in this case, you're obligated to buy the stock at the strike price if the buyer chooses to exercise the option. So as a put seller, you're giving someone the right, but not the obligation to sell you a set amount of stocks for a certain price by a certain date if they choose to. Let's look at Google stock, for example. If I have a strike price on Google at 180 and Google's currently worth 187 on the day that it expires, that person is not going to sell me the shares. They're not going to assign me the shares, because why would they sell me the shares at $180 per share when they're currently worth 187? There's a $7 difference there. Basically, for every 100 shares, that would be $700. This is the easiest way to think about it. A put buyer is basically buying insurance for their stock. A put seller is basically selling insurance and getting paid up front a premium. Let me tell you why I think you're going to love selling puts. Let's say you want to buy Apple shares, but Apple right now is currently, let's say 205. But you feel like 205 is overvalued for Apple. And you're like, man, I would really love to buy it, but at 205 is a little expensive for me. I'm willing to pay 197 for it. Great. You can sell cash secured puts at the strike price of $197 and collect that premium in the meantime to make income while you're waiting for Apple to drop down to that price. And if your guess is wrong and Apple goes up in price, well, guess what? You still collect a premium. You still made a profit even without owning the shares. So let me give you an example. Let's say Apple is trading at $205. The put option is for $190 strike price and it expires in 30 days. And it paid me $2.50 per share, which is a $250 premium that I collected instantly right up front. The contract size is one option and it's 100 shares, obviously. Each option of a contract controls 100 shares of that stock. Remember that. So if I sell this put, I'm going to collect the $250 up front. If Apple stays above $190 by the expiration date, it's going to expire worthless. I get to keep the $250 free and clear, and I don't have to purchase the shares. Now, if Apple falls below the $190 price, I am going to be forced to buy the 100 shares at $190, but I'll still keep the $250 premium regardless. But if Apple goes way below $190, and let's say it goes to $177, I'm still going to have to pay $190 per share to buy those shares, because that is the strike price that I chose, and that is the risk you take when selling puts. So in the world of options, there's something called the Greeks. And when you sell put options, there's a Greek called theta. Theta equals time decay. It measures how much of the value of an option decreases every single day, just from the passing of time, even if the stock doesn't really move much in price. When you sell a put, theta works in your favor because you want the option to lose value as fast as possible. Theta is your friend here. Theta is usually shown as a negative number for option buyers, but for you as a seller, it's positive. You collect that as time decay. Let me give you an example of theta in action, right? Let's say that you sell a $190 put option on Apple for $2.50 collected in premium. So you made $250. The option has a theta of 0.08 per day, 8 cents, which is $8 per day. On day one, you're going to collect $250 up front, right? You have 100 shares times $2.50 of premium equals $250 in your pocket. Day number two, all else equal, stock price stays the same. The option loses $8 in value, which is 0.08. 0.08 times 100 is $8. That's how we get those numbers, guys. So now the option is worth $242. You could technically buy it back cheaper. You collected $250. You could buy it back for $242 and keep the $8 and say, hey, I'm done with this. I don't want to do this anymore. Get all the risks off your hands. But let's say you continue. Each day moving forward, theta accelerates as expiration approaches. So especially in the last 2 weeks, the last 10 days of an option expiring, theta might increase to 0.15 or even 0.20 per day, meaning it decays a lot faster and you profit a lot quicker. And that's why I say theta is your best friend as a put seller. So here's a key takeaway. Write this down in your notes. Don't forget this. The closer that you get to expiration, the faster that option is going to lose value just from time passing. Let me show you a live example that I did in my portfolio earlier this morning. All right, so when you look at an options chain, if you've never seen an options chain before, you're going to look at this thing and be like, what the heck am I looking at? What are all these numbers and what are all these things on the side, right? If you look at this options chain right here, Google is currently trading at $183.57. The closest strike price right under that is $182.50. If you look on the right-hand side, you see that premium for $5.85. That means you're going to get paid $585 for executing that trade right now if that's what you decide to do. But just remember this, that is the closest strike price to the price of Google. That's why it's worth the most. If you go further out of the money, for example, 175 put, as you can see on the right-hand side, you're getting paid a lot less, $292. And why is that? Well, the stock has to move a lot further down to get to that price of 175 than it would to get to 182.50. So when you sell a put option, you need to have the money set aside to purchase 100 shares of the stock that you're doing this with. So for example, with this Google stock, right now it's currently trading at $183.50. I don't need $18,350. That's what 100 shares would cost me right now at that strike price. If I wanted to do this at 175, I would need 17,500. So I'll give you another example. Let's say you're doing stock A, right? Stock A is trading at $100. If you want to do the strike price of $95, you will need $9,500 to execute that trade and sell that put option. So I say that to say this. If a stock is trading at 150 times 100 is $15,000. It doesn't necessarily mean you need the $15,000 to sell that put option. You can do it at $14,000. You could be $1,000 short and say, man, I'm $1,000 short. I only got $14,000. I can't sell a contract on this yet. No, you can. You can sell the option at 140 because 140 multiplied by 100 is $14,000. So that would be your strike price of 140. And there you would be able to execute that trade. So going back to the put option that I just sold, I sold it for a strike price of 177.5. And as you can see on the bottom there, right under contracts, it says I collected $4.25. Remember, that equals $425 because when you sell a put option contract, that option controls 100 shares of that stock. So 425 times 100, $425. And once you submit that trade and it executes and goes through, that $425 premium goes directly into your buying power. So you receive the money instantly. You can literally do whatever you want with it. It'll be instantly in your buying power. You could use that to buy more stock, or you could use that to take it out in a week or so. You could do whatever you want with it. The money's in your account. So going back to the position that I have here, as you can see where it says the Google break-even price, if you're new to selling options, you might look at that and say, what the heck is that? I don't understand why it's showing 173.25. Well, that is my true break-even price, right? Because I am agreeing to buy Google at $177.50. This person or this bank, whoever bought this from me, they paid me $425 for that. So I collected $425 after paying $177.50 per share. If you look at my true cost basis, you subtract $425 from my strike price of $177.50, and the true break even of this play is $173.25 per share. So if I do get assigned these shares, I will really be in it for $173.25 per share. That's a pretty good discount comparing to the stock right now being at $183.76. It is very important for you to do this with stocks that you want to own anyways, because for me, my goal is to get assigned. That's why I sold this at $177.50. The goal is to get assigned. Now, if I don't get assigned and I don't get to purchase these 100 shares, tough luck. I collect my 425 bucks and I keep it moving. So let me give you another example. Like right here with SPY, like I showed you earlier on the screen, I've been selling puts on SPY. The only thing is it does require a little bit more money because SPY is currently trading at a higher price. If the strike price that I want to pick on SPY, for example, is $615, I need to have $61,500 set aside to make this trade go through. I don't advise you ever do this. I mean, Robinhood, I don't think lets you do that if you don't have the cash in your account. Do not sell a put option if you do not have the money set aside. I repeat, do not sell a put option if you do not have the money set aside. I don't recommend it. That is the riskiest thing you could do, because if you do get assigned and that assignment comes through and you don't have the money to buy it, you're going to be in a world of hurt. I don't suggest doing it. Let's not even talk about that. Okay. So do not do it. Moving on. So not only have I been buying individual shares of SPY because it is a great ETF for me to own long-term anyway, I've also been selling put options on SPY to hopefully get assigned 100 shares at a discounted price. And in the meantime, I'm collecting a premium. So as you can see here, on April 21st, I sold a $500 put option on the SPY. What does this mean? Again, this means I had to set aside $500 per share times 100 shares, that's $50,000 in order to execute this trade. And I collected $261 for doing so. So what it is again is I told the person on the other side who bought this from me, hey, if the SPY goes below $500 per share by this day, which is April 25th, I will buy them from you at $500 per share. Even if it goes down to $479, I'm still going to have to purchase them at $500 per share. And the ironic thing about this is that some people will tell you, well, that's risky. You know, hey man, Johan, your strike price is $500 per share, but what about when you get assigned if it's $487? Well, I'm going to pay $500 a share. What does it matter? What is the difference if I were to buy 80 shares right now at $500 a share and next week it goes down to $489? What's the difference? There's no difference. The only difference is that I didn't collect a premium to purchase them at a discount. That's the only difference. But if it does drop on you, guess what? You're holding 100 shares of a great ETF. That's why I say it is very important to do this with solid stocks or solid ETFs. Do not do this with some garbage company. Then you'll get yourself in trouble. When you do this with a solid stock or a solid ETF, you're in good hands. What I will do is if it does drop, for example, let's say I would have got assigned here. If I would have got assigned, I would have waited. If it dropped to 49 and I bought it at 500, cool beans. I got paid 261 bucks. It dropped to 49. I will sell a covered call on it in the future to collect even more premium. That's for another video. We're going to stay on selling puts here. That's for another video, but there's ways to make more money out of this, right? So what I will do is I will hold on to my shares. I still have the physical asset with me. I own the shares and I will wait for them to recover. There's literally no difference than you just buying shares and they go down in price for whatever reason. The only difference is that here you have a little bit of a leg up. You have some upside to you because you're collecting a premium. Let me give you another little piece of information that's pretty unique about selling put options. Just because I sold this put option for the expiration date of April 25th does not mean I need to wait till April 25th to let it expire. I can get out of this play if I want to before then. So what I did was on April 23rd, I bought back the option. That's how you close out the position. It sounds weird, but you're not buying anything. You're literally just giving them back some of your profit just to get out of it. So once you buy it back, you eliminate all the risk. Your bet's off the table. You don't have nothing involved in it no more. You got your money out. You don't have any more contracts tied to your name. It's pretty good to do this if for whatever reason you catch wind of something coming out and you think some big news are going to come out and last minute you don't want to get assigned the shares for whatever reason, you can get out of the contract. So let me give you a quick little rundown. On April 21st, I sold the original put option for the $500 strike price. I collected 261 bucks. 2 days later, on April 23rd, I wanted to get out of that play because I wanted to collect more premium. So out of the $261 I collected, I gave them back what it was worth, $31. I got out of that play and I instantly sold another put option on the SPY for the strike price of $515. The stock was going up. I wanted to keep up with the ETF. I wanted to keep trading it that way. So I made $261. I gave back $31. So I made a net profit of $230. So I collected $261 on the original put option. I gave it back for $31. I still made a net profit of $230. Then I sold another SPY put option at the strike price of $515 and I collected $360. And then I sold another one at the strike price of $520 and I collected another $451. Those two were expiring on the same day, May 2nd. As you can see at the bottom of the screen, on May 2nd, I bought back both of my SPY puts for $1 each. My $520 strike price, I bought it back for $1. And my 515 strike price, I also bought it back for $1. That's why you see that -1 there on the side, that -$1. And I do this for several reasons. One of them is it takes my risk completely off the table. And number two, it releases the collateral that I had held to the side to buy the stock in case I do get assigned. So for the 515 put, I collected $360. I gave back $1. I made a net profit of $359 on that one. And for the SPY put at 520, I gave back $1. So I made a net profit of $450 on that one. $359 plus $450, you're looking at an $809 profit in a couple of days. And then if you add the $230 that I did a couple of days before that, you're looking at $1,039 for just attempting to buy 100 shares or 200 shares of the SPY. I never got assigned. Unfortunately, I never got assigned. I wouldn't have minded if I got assigned, but I never got assigned. But what did I get? I got $1,039. I could do whatever I want with that money. So let's talk about some of the downsides to doing this. Some of the downsides are that if you do this with a garbage stock and you fall for the premium and you start chasing these high premiums on stocks that are no good, you could get stuck holding the bag for quite some time. Another kind of downside is that it does take a lot of money to do this with the stocks that are more stable. If you want to do this with a stock like Google or an Nvidia or like an Amazon, you need about roughly, let's say $19,000, $20,000, $21,000 to be able to sell some of these put options on these bigger tech stocks. But essentially what you're doing is you're creating your own dividend per se. You're collecting money from these stocks just in an attempt to buy them at a discount. So if I had to give you like a practical example of how selling put options work, let me give you an example of like your car insurance. Let's say you have Geico as your car insurance and you pay them, for example, $150 a month. If you don't crash your car, you don't go knocking on the door like, hey Geico, I didn't crash my car. Let me get my $150 back. No, they keep that premium because in case you do crash your car, they're going to front the bill to pay for it. Now, if you don't crash your car, they keep the premium. It's the same exact thing with selling a put option. If you sell the put option at $100 on stock ABC and that stock tanks to $79 a share, that guy gave you a $200 premium to dump those shares on you and save a couple $1,000 loss. But then again, it's really not a loss if you want to own the shares anyway and if you believe in the stock long term. You see where I'm going with this? Take it for what it is. You get the chance to purchase the stocks that you want to buy anyway and collect a premium in the meantime. These are stocks that you want to own for the long term anyway. And as you can see, the portfolio over the last month is up about $11,000. This does fluctuate on a day-to-day basis depending on the put options and the call options that I have sold. But man, I cannot stress enough, selling options is one of the safest trading strategies that you could practice in the market. I think it's one of the safest in my opinion. And again, the only true downside to investing this way and selling options on those types of stocks is that it does take a little bit of money. If you can see yourself selling options to give you that passive income every single month, kind of create your own dividend, let me know down in the comments below. Have you sold options already? Have you sold calls? Have you sold any puts? Is this your first time kind of speculating with this? Like, man, I kind of want to do it. I'm putting one foot in and checking it out. So yeah, pretty much just want to say thank you for coming out and hanging out with me today. If you have any questions, comments, or concerns, drop them down in the comment section below. And with that being said, I will catch you on the next one. Peace.